All right, back with some real estate tips from Team Ruggles. We are with Atlanta Communities Brokerage in Cartersville, Georgia. There are other branches of the Atlanta Communities throughout Georgia. We happen to work at the one in Cartersville. Today is the first part of a three-part series. Basically borrowing money with your house as collateral, all right? This is a good opportunity for people to fix up their houses, repair, remodel, or even upgrade or modernize, all right? So, what is it? How to get it, qualifications, risks, and taxes, all right? Those are the things we're going to cover with this HELOC. Again, it is a three-part series, and I'll get to the other two parts later on. I'll introduce them, and then there'll be other presentations with those. So what is a HELOC? A revolving line of credit secured by your home. It's like a credit card backed by your house. If you've ever talked to somebody in construction, a lot of construction companies, the big ones, in order to get the building materials that they need, they'll have a revolving line of credit, and they use that to get the materials, and they pay it off after they get the project done. Well, this is kind of the same thing, except with your house, all right? So you borrow, repay, borrow again during the draw period up to your limit. There's a draw period and there's a repayment period. Usually variable interest rates index prime plus one or lender margin, or plus one, plus two, whatever lender margin might be. Your home is collateral, so if you miss a payment, you're definitely gonna go into foreclosure, all right? It's a possibility. So, how does it work? Draw and repayment. Like I said, there's two periods, a draw period and a repayment period. In the draw period, it's usually 10 years, and this is where you can take advances as needed. You can draw money from that line of credit. Often, it's interest-only payments, so you're not putting anything toward the principal. Accessed via checks, transfers, or card. It varies by lender, but I would assume with the technology today, you're going to be probably electronic transfers, all right? So repayment periods, often 10 to 20 years. When the repayment period hits, all right, it's a separate period. So this is a different 10 to 20 years than that one, all right? So your line closes. There's no more new borrowing. You cannot draw money from your credit line. Payment becomes fully amortizing. What does that mean? It's not going to be just interest now. It's going to be principal and interest. So your payments are going to go up. All right? Rates remain variable unless you convert portions to fixed. All right? You can probably convert them to a fixed so you don't have that variable if there was agreement, or possibly another loan if you're able to. I don't know. Know your index margin, rate, caps, floors, and any teasers. Now, a teaser would be something like a lender would say, hey, for the first 3 months, it's just 3%. You don't ask about it, and it don't tell you anymore, and then boom, after the third month, your interest rate's 8%, all right? It's always good to find out what's going on with that. So how much can you borrow? Home equity is current appraised value minus what you still owe on your mortgage. That's your equity, all right, into your home. Well, basically what you have is what you've paid already, all right? So you have your current appraised value, what you owe, you subtract those two, and that is your equity, all right? So lenders use combined loan to value, and I'll have a slide later on that explains that a little bit better. CLTV is existing mortgage balances, desired HELOC limit, and it's divided by the appraised value. Typical lender cap is 80 to 85%. CLTV varies by lender and profile. So that means you, depending on you and your credit history and so forth. However, it usually stays right around in here. And the slide that has that example on it, I'll explain this just a little bit more. All right. So, common qualifications. Going to have credit score in the mid to good range, better pricing with higher scores. Of course, that's going to be with any type of money coming from a lender or a bank. Debt to income ratio, we talked about that last time, and the ratio is within the lender guidelines, okay? Sufficient equity and acceptable CLTV, all right? Combined loan to value, you need to have an acceptable one. And remember, it was that 80 to 85% max, all right? Documented income and employment, property, and occupancy type matter. It needs to be a residential home. It can't be, it cannot be outside that resident. It has to be for that residence, okay? Appraisal, valuation to confirm current market value. So, how do you get a HELOC? Estimate your equity and CLTV using the formula. Shop at least 3 lenders. Request full fee and rate details in writing, and I'll go over that a little bit more. All right. Apply and provide documents. You're going to have your ID, your 1099s, pay stubs, W-2s, tax returns, mortgage statement, insurance. It's just like any other time. You're going to have to give them all of your blood out of your body. Okay, you're going to have to give them everything, okay, because they need to check and see everything that you can handle these payments, all right? Expected credit pull and appraisal valuation, okay? Anytime you go for money from a bank or lender, you're going to have a credit pull, all right? So you close, get access to the line, and draw as needed during the draw period. Again, you can only draw money during the draw period up to the amount that you're qualified for. So appraisal, valuation, and recording fees. All right, check into all these fees, annual fees or inactivity fees on some lines. If you're not drawing frequent enough, they may charge you. All right, early termination closure fees, minimum initial draw requirements. Some lenders have a minimum that you have to withdraw. You can't just draw a lower amount. Variable rate payment changes over time. Interest only does not reduce the principal. So your principal is going to stay the same throughout the draw period because you're pretty much only paying interest. When we get to the repayment period, that's when you start paying on the principal. All right. The variable rate and interest could change, so you've got to monitor that as well. So some key risks. Your home is at risk if you default, so you have a foreclosure. All right, and that's basically, you really do not want that. Rate risk, payments can rise if the index increases. All right, so again, the variables with the percentage rate or interest rate. End of draw shock, when full amortization begins. All right, that is going to boost your payment up. So you need to be able to cover that payment. You need to check and make sure that your payment, or you can handle that type of payment. Lender can freeze or reduce the line if values fall or risk increases. So if they see you as an increase in risk for some reason, then they can freeze or reduce the line of credit. Over leveraging for non-improvement spending can strain finances. Basically, stick to, and this is just advice for me, for a HELOC, stick to repairs, remodeling, upgrading, modernizing your home. The 2 big ones, kitchen and bathroom. Those are going to add value to your home quickly, all right? Especially modernizing the kitchen, if it is not. So stick with those. Know what you want to do with the project. Budget the project so that you're not over leveraging. You're not spending more than what you really need to, okay? And that goes for spending on things that don't pertain to your project. All right, we'll get to that in a second. So taxes, when is HELOC interest deductible? Only if you itemize deductions and use the funds to buy, build, or substantially improve the home that secures the loan. And this is what I would use this for if it is good for you to use. If it fits what you want and your needs, this is what you want to do in order to repair your home, modernize, or whatever. Personal uses for debt consolidation, tuition, vacations generally are not deductible. You're not going to be able to deduct those. Subject to overall IRS mortgage interest limits. 750 cap for post 2017 acquisition debt. Consult a tax professional for this type of information. All right. Keep receipts and records showing how funds were used for improvements, because that is going to be itemizing your deductions. So here, as promised, is the other two. We are going over HELOC. Part 2 is going to be home equity loan. Part 3 is going to be cash out refinance. And we'll go over these two in a separate presentation, okay? But we're going over HELOC today. And these are all ways we can borrow against the home in order to get money, okay? So prioritize a value, adding home improvements. This supports potential tax deductibility. Again, if you're going to use this money for something else besides repairing your home, modernizing your home, I strongly suggest that you rethink it, okay? Keep the CLTV conservative. Below 80 to 85% is a common target. I'll talk about that in a second. Stress test your budget at 2 or 3% higher rates at amortization. Avoid using the HELOC as a long-term revolving debt for lifestyle spending. You don't want to do that. Set up an auto pay. Monitor your variable rates so that you're not surprised by a higher payment. You're monitoring the variable rates. So here's how we get it. You can sit down and you can put all these numbers in, and then you're going to add your current first mortgage, your other liens, if you have any liens on your home, and your desired line of credit limit that you want. All right, you're going to add all those together and divide it by your appraised value. That is the appraised value of the house at that moment. All right. Many lenders cap CLTV around 80 to 85%. What does that mean? That means this number needs to be below 85% in order to get this limit that you had put down. All right. If it's lower, you're a possibility of getting better rates. If it's higher, you're probably not going to get the line of credit. So that's what that means. All right. These have to be no higher than this. If it is higher than that, then you're probably not going to get the loan. So what do lenders, all right, when you go look for a lender, basically look at their plus margin. All right, what is their lender fees and lender rates? If they're trying to entice you with some early interest rates that are lower, but then it boosts up to even higher, and it doesn't average out to even another lender's, then that might not be a good decision. Rate caps, some might go higher, some might go lower. Draw period length, repayment terms, interest only allowed, any fixed rate conversion options, so that when you get to that end of draw, you can get a fixed rate and you don't have to keep relying on a variable rate. Fees, the appraisal, the annual fee, inactivity fee, any early closure fees, whether they have a minimum initial draw, all right? Closing costs, who pays, how are they recouped if closed early, prepayment penalties, access methods, see how it is going to be transferred to your account, servicing, who holds the line after closing, okay? So all those things need to be discussed with your lender. All right? Not only that, but these are other things that you want to discuss with your lender. Ask the lender for your starting APR and payment at your planned draw amount. All right? So model that payment with a +1, +2, +3. Ask him to give you those scenarios so that you can see if you can handle those payments if the variable fluctuates that much. All right? Plan for end of draw amortization. Ask him to give you that scenario so you might be able to see what payments would be like at the end of draw, all right, which would be your repayment period. And keep a 3 to 6 month emergency fund outside of your HELOC. It may be in a savings account or so forth, unless there's any surprises, or if there's any surprises that might come up that you're not prepared for. So our final tips with the HELOC: use the funds strategically. Avoid non-essential spending. Save all receipts for improvement-related expenses so you can itemize and get some deductions. Revisit your rate and CLTV annually. Consider partial paydowns in high-rate periods. If you might sell soon, confirm any early closure fees and payoff process. All right? So, again, yes, a lot of people use that to fix up their home to get it prepared to sell. So if you are looking to sell early, make sure that if you pay it off early, make sure there's no fees, or if there is a fee, you are aware of it. All right? So those are some of the final tips. Again, it is a 3-part series: HELOC, home equity loan. A HELOC is a line of credit. Those are different. And cash out refinancing. All right? So this was presented by Team Ruggles. We're with Atlanta Communities, serving Bartow, Floyd, and Gordon counties in Georgia. The number for the office is 770-240-2000. It's a directory. You can either choose my wife, Kim Ruggles, or myself, Eric Ruggles, and it will directly dial to our phones, all right, so that we can pick up and help you out in any way we need to. You have any questions, put them in comments. I'd be glad to answer them. Also, if you're watching on YouTube, please give me a like and subscribe to my channel. My channel has a lot of different things on it, but real estate is one of them, and you'll see the real estate playlist on there, and you can click on those for other tips and advice in real estate. So, 3-part. We'll go with home equity loan next time, and thanks for watching.